Hi, my name is Karthik Shetty and this presentation is on why is debt cheaper than equity. But first let us understand what do they basically mean. Debt is an amount borrowed by a company or a firm with a promise to pay back the principal amount along with interest. Common examples include bank loan, bonds and debentures. While equity is an investment by shareholders or owners in exchange of a stake in the company or a firm. Debt promises the investor to pay back the amount borrowed along with a sum of interest. Now, the interest could be variable or fixed in nature. Nevertheless, it is based on a pre-negotiated understanding between the borrower and the lender. While in equity, there is no such understanding between the investor and company. Hence, in debt, there is a legal obligation to pay back, but in equity, there is no such obligation. That said, if a company does not give consistent returns in the long run to its equity holders, it can damage its reputation in the financial markets, thus making the future fundraising activities more difficult in both debt and equity markets. The debt holders enjoy another advantage. That is, interest and principal are given higher priority in the payment plan. Although in real life, companies will have a much more complicated payment waterfall as what is shown on this current slide, but I hope this would give you a basic understanding. As you can see, generally companies prefer making payments towards their direct materials, wages and factory expenses, and after which they pay other mandatory expenses such as salaries, interest, principal and rent. Insurance. These kind of expenses have a specific due date and therefore are not only critical but also obligatory payments in nature. And after these, there are other category of expenses which are incidental and discretionary in nature. A few examples include general sales and administrative costs, advertising expenses and marketing costs. While these are important expenses, however, the amount can be increased or decreased depending on the revenue and profitability being generated. Dividends can only be paid out of net profit, and net profit is the amount that remains with the company after paying taxes from profit before taxes. Dividends can only be paid from net profit, and as mentioned before, a company still has a choice whether to pay dividends or not. Besides, debt can be secured. A debt can be secured against assets such as land, building, shares, deposits, machineries, etc. In certain cases, banks or financiers can also ask for personal guarantees to be given by promoters of the company. Resultantly, secured debt is cheaper than unsecured debt, and yet unsecured debt will be significantly cheaper than equity. In a nutshell, amongst the three avenues of funding, equity will be the most expensive. While unsecured debt will be less expensive than equity, it will be more expensive than secured debt, and secured debt would be the cheapest form of funding. Providing security to lenders can give a reasonable assurance that their money will be paid back by the borrower, since in ideal conditions, no company would be willing to let go of their assets. Now, what happens in a worst case scenario? In simple terms, a company could cease to physically exist. In a worst case scenario, a company will have to let go of their employees and sell all their assets in order to repay the lenders and creditors. This is called liquidation. An event of liquidation is most often triggered by default if the company is unable to pay its lenders or creditors. In liquidation, assets of the company would be sold, and if that asset is secured against a particular debt facility, the proceeds will be first paid back to the relevant lenders. The remaining proceeds will be used to pay statutory dues, fees of the liquidator, wages, salaries, unsecured portion of debt, unpaid portion of secured debt if any. Eventually, equity shareholders will be paid, and more often than not, the proceeds will be negligible as compared to their original investment. So which is riskier, equity or debt? Of course, equity is riskier because debt is protected in many forms as explained before. And therefore, the return expected by equity investors would be significantly higher than debt, thus making debt cheaper than equity. But does it mean that debt is a better form of fundraising than equity because it is cheaper? And whether it is a better investment avenue because it is less riskier? The answer is not that straightforward, and for this to dig deeper, we'll have to understand both investors and the company's perspective. Let's begin with investors' point of view. The preference to invest, whether on debt or equity, depends on the risk appetite of the investor. An investor who is more risk averse in nature will prefer to invest through debt, while on the other hand, if the investor is more open towards risk and has a higher expectation of return, would prefer investing through equity. A debt gives stable income with more certainty. Even though the interest rate would be variable in nature, it can be better predicted as compared to equity. An equity does promise a higher income in a way, and over a longer term beats inflation. But remember, if the underlying equity investment does not perform well, the return can also be negative. And therefore, if the investor is an individual, it is recommended to have a healthy mix of debt and equity in their portfolio. But that being said, it also depends on the organization's objective. For example, banks are supposed to give loan to borrowers by taking money from the depositors. And because they are regulated by the central banks of the respective countries, they cannot invest through equity in ideal conditions. While on the other hand, organizations like private equity firms and hedge funds have a higher expectation of returns, and they prefer investing through equity. Now let us understand a company's perspective. The first thing that is worth highlighting is that raising funds through debt and equity is not mutually exclusive. In fact, most of the listed firms, or almost all the listed firms, have both debt and equity in their balance sheet as sources of their funding. That being said, debt is mostly preferable by matured companies who consistently generate positive EBITDA, cash flow, and revenue so as to service their debt. Equity is preferred by high growth companies such as startups or companies which are smaller in scale. Equity could also be preferred by matured companies if they have new projects in pipeline which are yet to break even. Another advantage of having debt in a funding mix is that it helps in increasing the return on equity to equity shareholders. For example, if a company generates a return of 15%, while the average interest rate is 7% for the company, the remaining 8% automatically belongs to the equity shareholders, thus increasing the returns. To conclude, debt is cheaper than equity because of the lower risk associated with it. There is a reasonable assurance on receiving back the principal along with interest amount, while equity, being a riskier asset, commands higher return. But that said, debt and equity mutually coexist together and derive benefit from each other. This is Karthik Shetty, and thank you for your time.